Hello everyone, welcome back. The annual meeting of central bankers in Jackson Hole, Wyoming has come to an end. In this video, I will briefly touch upon the key takeaways without boring you too much, hopefully. First, following the meeting in Jackson Hole, Fed Chair Jerome Powell said, and I quote, "Time has come for the central bank to cut interest rates," adding that the Federal Reserve does not seek nor welcome further cooling in the labor market. Given the latest downward revision of 818,000 jobs that were reported on paper as jobs gained but never actually existed, which is the biggest revision on record, Jerome Powell's statement seems to be odd, to say the least. It clearly skips over just how concerning the state of the labor market is. Anyone can see it with a naked eye, and any further cooling would likely lead to a full-blown depression. The next Fed meetings are scheduled for September the 18th, November the 7th, and then the final one this year will be held on December the 18th. At each one of those meetings, the Federal Reserve is now expected to deliver a rate cut, likely either 0.25%, but less likely anything above that. So what is my take on this? Well, if you thought that inflation has been high up until now, let's just wait and see what happens following those rate cuts. The Fed is now 100% done pretending that they're going to do anything about inflation. Therefore, I would expect inflation to increase. The second and arguably far more important takeaway is that the United States Treasuries, its debt, is no longer seen as a safe investment option. What will U.S. government do as its tax receipts are falling and there are wars to fund abroad? Things are going to get really tough. Well, historically, U.S. Treasuries have been perceived to be the safest of safe haven securities, of safe haven assets. Backed by the full faith of the U.S. government, the level of trust in them used to be truly unprecedented. However, that is no longer the case. New research that was just presented at the conference in Jackson Hole concluded that the U.S. Treasuries are now no longer different than those securities that are issued by Germany, by France, or even Great Britain. Considering the economic decline of Europe, that's not really a good company to be in. The research examined shifts in investor behavior and found that investors did not, as they had during previous episodes of global financial stress, they did not pile into treasuries and drive up their value by increasing demand. Instead, investors marked down treasury securities, similarly to what they did for bonds from other countries. This isn't even the worst part of this. This research used 2020 data. Well, we all know what happened then. Now, 4 years later, with the massive national debt above $35 trillion, the last time I checked, the national debt stood at $35.2 trillion, and the interest on debt now exceeding defense spending, the U.S. Treasuries are likely even less appealing as a safe haven asset, as an investment. The third point that I would like to make in this video is on the Fed Chair Powell's statement regarding the labor market. Powell admitted that, quote, job vacancies have fallen. Well, first of all, the massive 818,000 downward revision that was just announced a couple of days ago, it was in addition to those monthly adjustments that we've all gotten used to. Additionally, as of July, the latest data available, the unemployment rate has increased. But what nobody is talking about, including Fed Chair Jerome Powell, is that according to the most recent Fed Reserve survey, the number of people who are looking for a job has spiked. So unfortunately, these days, fewer businesses are hiring. As Powell said himself, the number of vacancies decreased. Sure, that's true. But what he failed to include, what he failed to tell you is that it happened while the number of people looking for a job increased to its highest level since 2014. The proportion of respondents seeking employment over the past 4 weeks jumped to nearly 28.4% from 19.4% in July of last year. The survey also showed decreased satisfaction with pay and benefits among employees. Approval ratings on wage levels dropped by 3.2% in the United States. Powell said, "Overall, the economy continues to grow at a solid pace, but the inflation and labor market data show an evolving situation." Well, that seems like a code word for something bad to happen. "The upside risks to inflation have diminished, and the downside risks to employment have increased." Jerome Powell telling us that the economy continues to grow at a solid pace is likely from the inflation is transitory playbook. I'm sure you all remember that. When the biggest portion of new jobs are government jobs, and the highest number of new jobs are part-time employment opportunities, while full-time employment numbers are actually declining, and when government spending is the main driver of inflationary pressures, that means the private sector is actually not really growing at a solid pace, as he tells us. So his statement is likely very difficult to support with any factual evidence. Now, moving on, the fourth and the final observation of mine that I will share with you in this video, the dollar index has declined to its lowest level following Powell's commentary on rate cuts. On a year-over-year basis, by the way, the dollar index declined roughly 10%. Today, the dollar index dropped even more, while gold and 10-year bonds rose. The announcement of the rate cut is clearly seen as overly political. With the real inflation being far above the reported rate, cutting rates now is likely to cause inflation to pick up, while employment has been slowing down considerably. The labor market will likely show further declines, further deterioration through the end of the year. There is a very scary word that comes to mind when unemployment rises and inflation rate increases. Do you know what that word is? The word is stagflation. I'll go ahead and include Fed Chair Jerome Powell's comments in this video as well. You will see it as a separate clip towards the end of this video, so make sure that you don't leave right away if you're interested, if you want to hear what he had to say. Thank you for watching. I do appreciate your time. Remember to like, subscribe, and share, and I will see you back here tomorrow. Enjoy the rest of your day.
Inflation has declined significantly. The labor market is no longer overheated, and conditions are now less tight than those that prevailed before the pandemic. Supply constraints have normalized, and the balance of risks to our two mandates has changed. Our objective has been to restore price stability while maintaining a strong labor market, avoiding the sharp increases in unemployment that characterized earlier disinflationary episodes when inflation expectations were less well anchored. While the task is not complete, we have made a good deal of progress toward that outcome. Today, I will begin by addressing the current economic situation and the path ahead for monetary policy. I will then turn to a discussion of economic events since the pandemic arrived, exploring why inflation rose to levels not seen in a generation and why it has fallen so much while unemployment has remained low. So let's begin with the current situation and the near-term outlook for policy. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. The FOMC's primary focus has been on bringing down inflation, and appropriately so. Prior to this episode, most Americans alive today had not experienced the pain of high inflation for a sustained period. Inflation brought substantial hardship, especially for those least able to meet the higher costs of essentials, like food, housing, and transportation. High inflation triggered stress and a sense of unfairness that linger today. Our restrictive monetary policy helped restore balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remained well anchored. Inflation is now much closer to our objective, with prices having risen 2.5% over the past 12 months. After a pause earlier this year, progress toward our 2% objective has resumed. My confidence has grown that inflation is on a sustainable path back to 2%. Turning to employment, in the years just prior to the pandemic, we saw the significant benefits to society that can come from a long period of strong labor market conditions. Low unemployment, high participation, historically low racial employment gaps, and with inflation low and stable, healthy real wage gains that were increasingly concentrated among those with lower incomes. Today, the labor market has cooled considerably from its formerly overheated state. The unemployment rate began to rise over a year ago and is now at 4.3%, still low by historical standards, but almost a full percentage point above its level in early 2023. Most of that increase has come over the past 6 months. So far, rising unemployment has not been the result of elevated layoffs, as is typically the case in an economic downturn. Rather, the increase mainly reflects a substantial increase in the supply of workers and a slowdown from the previously frantic pace of hiring. Even so, the cooling in labor market conditions is unmistakable. Job gains remain solid, but have slowed this year. Job vacancies have fallen, and the ratio of vacancies to unemployment has returned to its pre-pandemic range. The hiring and quits rates are now below the levels that prevailed in 2018 and 19. Nominal wage gains have moderated, and all told, labor market conditions are now less tight than just before the pandemic in 2019, a year when inflation ran below 2%. It seems unlikely that the labor market will be a source of elevated inflationary pressures anytime soon. We do not seek or welcome further cooling in labor market conditions. Overall, the economy continues to grow at a solid pace, but the inflation and labor market data show an evolving situation. The upside risks to inflation have diminished, and the downside risks to employment have increased. As we highlighted in our last FOMC statement, we are attentive to the risks to both sides of our dual mandate. The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. We will do everything we can to support a strong labor market as we make further progress toward price stability. With an appropriate dialing back of policy restraint, there is good reason to think that the economy will get back to 2% inflation while maintaining a strong labor market. The current level of our policy rate gives us ample room to respond to any risks we may face, including the risk of unwelcome further weakening in labor market conditions. So let's now turn to the questions of why inflation rose and why it has fallen so significantly even as unemployment has remained low. There's a growing body of research on these questions, including Gowdy Eggerson's work, which we'll shortly discuss, and this is a good time for this discussion. It is, of course, too soon to make definitive assessments. This period will be analyzed and debated long after we are all gone. The arrival of the COVID-19 pandemic led quickly to shutdowns in economies around the world. It was a time of radical uncertainty and severe downside risks. As so often happens in times of crisis, Americans adapted and innovated. Governments responded with extraordinary force, especially in the United States. Congress unanimously passed the CARES Act. At the Fed, we used our powers to an unprecedented extent to stabilize the financial system and help stave off an economic depression. After a historically deep but brief recession, in mid-2020, the economy began to grow again. And as the risks of a severe extended downturn receded, and as the economy reopened, we faced the risk of replaying the painfully slow recovery that followed the global financial crisis. Congress delivered substantial additional fiscal support in late 2020 and again in early 2021. Spending recovered strongly in the first half of 2021, and the ongoing pandemic shaped the pattern of the recovery. Lingering concerns over COVID weighed on spending on in-person services, but pent-up demand, stimulative policies, pandemic changes in work and leisure practices, and the additional savings associated with constrained services spending all contributed to a historic surge in consumer spending on goods. The pandemic also wreaked havoc on supply conditions. 8 million people left the workforce at its onset, and the size of the labor force was still 4 million below its pre-pandemic level in early 2021. The labor force would not return to its pre-pandemic trend until mid-2023. Supply chains were snarled by a combination of lost workers, disrupted international trade linkages, and tectonic shifts in the composition and level of demand. Clearly, this was nothing like the slow recovery after the global financial crisis. Enter inflation. After running below target through 2020, inflation spiked in March and April 2021. The initial burst of inflation was concentrated rather than broad-based, with extremely large price increases for goods in short supply, such as motor vehicles. My colleagues and I judged at the outset that these pandemic-related factors would not be persistent, and thus that the sudden rise in inflation was likely to pass through fairly quickly without the need for a monetary policy response. In short, that the inflation would be transitory. Standard thinking has long been that, as long as inflation expectations remain well anchored, it can be appropriate for central banks to look through a temporary rise in inflation. The good ship transitory was a crowded one, with most mainstream analysts and advanced economy central bankers on board. I think I see some former shipmates out there today.